Hi guys, today I'm going to be going over what external financing is and then run you through a practice problem. Basically what external financing is when a company wants to borrow money from other sources so that they can use it to cover their costs instead of using their profits. They can get this money from issuing a bank loan, issuing shares to investors, getting it from grants, or even family and friends. A reason why they don't want to use their profits to cover their costs is because they want to use it in other departments or areas of their business to invest and grow the business. As you'll see in the following problem, I'm going to be using the projection method to solve it. The projection method is when you project your net income for the year, and you also need to project your balance sheet items, which is your total assets, total liabilities, and your ending equity. Really, to find your external financing, you only need your balance sheet elements. However, since our ending equity formula requires the net income, we need to project that as well. To start off, we know that our revenues are increasing by 25%, and last year our revenues were $450. So we'll multiply it by 1.25 to show the increase. Our costs, as it mentions in the question, our current assets, costs, and accounts payable maintain a constant ratio to sales, which means that they increase by the same amount. So our costs, which were $400 last year, will also increase by 25%. We know that our revenue minus our costs is our income, and we know that we also need to subtract our taxes paid, which is our tax rate times our income. And so our net income ends up being 41.25. Next, our current assets are increasing in proportional to sales as well. So it'll be 400 times 1.25. Since nothing is mentioned about our fixed assets, we assume that they stay the same. So when we total these up, our total assets are 1,000. We know that our accounts payable also increases in proportion to sales, so it'll be 100 times 1.25. And we assume that our notes payable will stay the same, and our long-term debt will stay the same. Our total liabilities are $625. Moving on to our ending equity. So we know that the problem gives us our beginning equity, which is $300. This is where our net income comes in. So we have that as 41.25, and we also need to subtract our dividends paid. It's mentioned that the firm pays no dividends. In order to find our external financing needs, our last step will be subtracting our total assets and our total liabilities plus our ending equity. The reason why we do this is, if you'll notice, our total liabilities is basically the debt of the company, which is money you borrowed, such as bank loans. And our ending equity is similar to issuing shares to investors to gain more money. So this is the money we have, our total liabilities and our ending equity. Our total assets is money we've used up to buy assets for the company. If we have more assets than we do in liabilities and equity, that means we need to borrow more money to be able to cover our costs for those assets. So we know we have $1,000 in assets, and we know that our total liabilities plus equity means we have $966.25 in funding. Thus, since our assets are more, we need 33.75 more in external financing.